Good morning from our global headquarters in New York. I'm Manus Crenny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's start that agenda.
No deal. President Biden decides to block Nippon Steel's takeover of U.S. Steel. New year, new drama. Congress gathers to vote for the next Speaker of the House. And FX in focus this morning. Beijing lets the yuan weaken to a 2023 low. Risk parity looms for euro dollar. Good morning, Manus.
Danny, good morning. How quickly will we trade down to parity? That's a question we can put to our FX guest. Equities this morning, small bounce here this morning. Lisa Shallot, I like what she said yesterday. Show me the year. That's what you're looking for in terms of corporate earnings. You have come off 50% over the past 2 years. But we're bid this morning, up by 0.5%. Roll it over, have a look at the bond market. Jobless claims at an 8-month low yesterday. The rally dissipated. $15 billion worth of corporate bonds were priced yesterday. It looks as if we're in for a monster month of issuance here in the United States of America for the corporate bond market. Get out early, get it done.
And meanwhile, looking at some individual stocks, Manus, U.S. Steel plunging after President Biden is said to have decided to block the sale of Nippon Steel, those shares falling 8.4%.
Another stock in focus, Tesla rebounding after dropping nearly 6%. This adds its annual EV sales drop for the first time in over a decade, rebounding by 1 1/8 this morning.
And rounding things off with Stellantis, that dropping this morning. It's fallen off the list of who can receive tax credits, eligibility for electric vehicle. Those shares down more than 1.5%.
Well, in just a few moments, we're going to catch up with Hardman of MUFG. And later in the hour, State Street's Cayla Seder joins us to talk through her views on where to put your money at play in the equity market. But these FX markets really are taking the whole center stage, Danny. It's not a question. I think people are marching time for that parity trade in euro dollar.
And it's not just the euro, it's the yuan, as you pointed out. It is across the board, this dollar strength, as other economies from China to Europe to emerging markets are weakening. At what point, though, does that come back around for the U.S.? At what point does the most clean, dirty shirt get a little bit more dirty in this trade?
Well, certainly the Chinese are throwing spoilers out there in terms of letting the currency just fade a little bit this morning. And with that in mind, let's just have a look at the onshore yuan. You're seeing a level here break below levels that we haven't seen since 2023. Now, this is interesting ahead of the proposed tariffs that may well come. But it's more about the FT story this morning, Danny. We flagged this, you flagged this to me when we sat down and talked about FX this morning. The PBOC are beginning to behave more like the Fed. That's the possibility. Cutting rates, they told the FT they would do that at an appropriate time in 2025. But the role of interest rate adjustments, the likely cuts will be appropriate in 2025. They're going to prioritize the role of interest rate adjustments, and they have quantitative objectives. Let's take that viewpoint to Lee Hardman, senior currency analyst over at MUFG. Lee, good to have you with us this morning. So the PBOC potentially morphing itself much more towards a Fed ECB style one interest rate, guiding the market perhaps rather than loan growth at any cost. How significant a pivot is this potentially at the start of 2025?
Yeah, well, I think the messaging that we've heard from the leadership in China has signaled very clearly that they're going to be more proactive, both in terms of fiscal policy support this year for growth and at the same time adopting a looser policy stance for monetary policy. So I think the market is already anticipating that we will see more aggressive rate cuts from the PBOC this year. And as we look at the performance of the Chinese bond market in December, we saw a very sharp drop in government bond yields to new record lows. And we think that is increasing the likelihood of greater policy divergence between the PBOC and the Fed at the start of this year. And with yield spreads now moving sharply against the renminbi, we think the path of kind of least resistance, so to speak, is for dollar CNY to continue to move higher. Our forecast for this year sees dollar CNY moving up towards the 750 level. But to be honest, the risks are very much that we could see an even bigger move lower for the renminbi this year.
Lee, to that point, on the bond market, we saw 10-year yields in China dip below 1.6% for the first time today ever. You saw 30-year yields last month move below that of Japan for the first time ever. Is an exaggeration to say we are seeing a type of Japanification happening in China, where you have deflation and low growth, the likes of which that Japan has been struggling with since the 90s?
Yeah, I mean, that's definitely one way of looking at it. Certainly interpreting this drop in yields is not just potentially the anticipation of rate cuts to come from the PBOC, but also, I guess, growing kind of skepticism or doubts over the ability or the effectiveness of monetary policy to boost growth. So they're kind of pushing on a string, so to speak, in terms of cutting rates. Will they really be able to generate much stronger growth in China going forward? And that certainly supports our own view that we think one of the channels through which China will also need to help to support their economy will be to allow the renminbi to weaken as well this year. I think certainly there's very likely we think that incoming President Trump will put in place further tariff hikes on China, which will hurt external demand for China. So they're going to have to rely on, obviously, a weakened renminbi to offset some of that impact from the trade tariffs. And at the same time, they also need to be more active in terms of boosting domestic demand growth as well.
Well, let's see what their moderately loose monetary policy in 2025 looks like, Lee. Let's talk more about the dollar. Up 8% last year. I mean, it was a phenomenal year, the best year since 2015. And we put a lot of that on in that last quarter of the year, up 7%. Exuberance, exceptionalism, rate differential politics, take your choice in terms of the driver. Does that exuberance really endure, or is it jawboned out on January the 20th?
Yeah, like you say, we are taking the view that we think this time around that the dollar can continue to strengthen in the first year of Trump's second term. Obviously, if you look back at his first term in power, the dollar actually weakened in the first 9 months. But we think this time things are different. Looking back at 2017, one of the things which helped the dollar to weaken was the fact that we saw a rebound or strengthening of global growth. And this time around, we think global growth, certainly over the next 6 to 12 months, will remain relatively weak, which should help to keep the dollar strong. And at the same time, we have this, obviously, policy divergence, which is opening up between the Fed and other major central banks. We think the Fed is likely to pause their rate cut cycle in January, and there's a possibility as well that they may even keep rates hold in March if we see Trump being very active in terms of putting in place higher tariffs at the start of his first term and other potentially inflationary policies such as tightening immigration in the US. So from that perspective, when you look at other central banks like the ECB, the Bank of England here in Europe, and also the PBOC, who are likely to keep cutting rates at the start of this year, to us that policy divergence there is dollar supportive, alongside, obviously, like I say, the risk of those higher tariffs being putting in place, which we think ultimately is dollar supportive as well. So it is difficult to see what's going to turn around the dollar right now, other than maybe Trump being a bit more cautious and maybe holding back potentially on those tariff hikes.
Lee, how do you understand the timeline for all of this? Because presumably, if we get some of these policies worked through this year in 2025, which, by the way, already it's been a quite contentious congressional Congress session even before we had the new Congress sworn in, but presumably some of these policies, we won't see the real effects of it until 2026. Is headline risk enough to move dollar to get some of the strength you're talking about?
Yeah, I think immediately we are expecting him to focus more on the tariff policies and potentially immigration policies, whereas, like you say, the fiscal policy side of things and the tax cuts would potentially come further down the line. So for us, I think that would be enough to keep the dollar stronger at the start of this year. But like you say, once we move further down the line, once the dollar becomes even more stronger, the market then may start to doubt whether it can be maintained at such strong levels. We are expecting at some point this year that Trump will start to display some concern over the strength of the dollar, and potentially with US yields remaining higher as well, we may start to see some signs of weakness coming through in the US economy. And if we do start to see more pushback from Trump over dollar strength, and as we move closer towards the end of this year, and we have obviously Fed Chair Powell's term coming to an end in 2026, the market then may start to speculate over the possibility of Powell being replaced by someone who's maybe more open to looser monetary policy at the Fed. So that in itself may help to take some of the strength out of the dollar as we move through this year.
Lee, that's got a consequence for the euro. Do you get a sense that, on a sliding scale, Mexico and China are at one side of this tariff risk, Europe and Canada are at another? So do we exhaust ourselves, take ourselves to parity, and then do you expect some kind of a bounce from that? Is there an exhaustion trade to come?
Yeah, like we are getting to levels now where the euro would be considered deeply undervalued against the dollar. And if we look back historically, levels below parity haven't lasted for a long period of time. So in the past, once we've got down towards parity or just below, that has been, from a kind of a longer term perspective, provided more attractive entry points to buy the euro. So we do think we could follow that kind of playbook, but at this point in time, we think it's probably too premature to think that the euro is about to bottom against the dollar at this point in time.
Yeah, euro 102 this morning, a little bit of strength. Lee, thanks so much for joining us this morning. Lee Hardman of MUFG. Let's get you some other top stories that are trending on the terminal this morning. The U.S. banking system's reserves have tumbled below $3 trillion. That's the lowest level since October of 2020. Year-end dynamics have forced banks to pare balance sheet intense activities in order to shore up their books. Strategists have said that the level of reserves necessary to be comfortable is somewhere between $3 and $3.25 trillion, including a buffer.
China is planning to increase its scrutiny on technology exports to make battery materials in order to protect its dominance in the global battery and EV production. This comes against a backdrop of rising competition with the U.S. in everything from critical minerals to semiconductors. The proposed curbs target a selection of processes used to make lithium chemicals that are crucial to battery performance.
Semaphore reporting that Meta is replacing Global Affairs President Nick Clegg with Joel Kaplan, the company's most prominent Republican, with tech leaders across companies appealing to President-elect Donald Trump. Kaplan has argued against Meta restrictions on political speech, arguing that the policies mute conservative voices.
Coming up on the show, no dice. President Biden is set to block Nippon Steel from taking over U.S. Steel. More on the story on Bloomberg.
It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. Shares of U.S. Steel falling in the pre-market nearly 8.5%, or a third percent, I should say. President Biden deciding to block the takeover from Nippon, which would seemingly kill the $14 billion deal before President-elect Donald Trump takes office. Let's bring in Bloomberg's Mike Shepard, who joins us from Washington. So, Shep, is that it for Nippon Steel?
Well, it really looks like it, Danny and Manis. The die is cast here. We have seen President Joe Biden signal his opposition to this transaction for months now. It became an issue during the presidential campaign. Not only was he opposed, but President-elect Donald Trump also made clear during his eventually successful run for office that he was opposed as well and would seek to block it if it were still around should he take office. Remember that Biden brings to this transaction a view toward labor that is very favorable. He sees himself, and organized labor in many ways would agree, as one of the most pro-union presidents in U.S. history. So with the union objections to this deal and the potential national security implications that have been raised through this process of a foreign company taking over an iconic U.S. steelmaker or manufacturer, it really seemed pretty clear that this was it. The companies, U.S. Steel and Nippon Steel, have signaled that they may take action in court to try to overturn whatever decision Biden may make to overturn this deal. But their chances of getting the president's decision here reversed really remain unclear legally.
It's interesting, Mike, isn't it, that the risk to national security of the United States was against an ally, one of their core Quad allies in Asia. I know that there are issues around supply to the United States, but that's an interesting point. What does all of this really mean for U.S. Steel? Who potentially can save the company? What's it going to mean? Does it mean you've got to find a U.S. buyer? Are there any left? The people who were interested in U.S. Steel, they've already long gone and done other deals. What are the repercussions, Mike?
Well, the repercussions are wide-ranging, and you pointed first to the whole national security question, and this will certainly ruffle feathers in Tokyo with a close U.S. ally. The way the U.S. sees it in terms of national security concerns is not so much that Japan will suddenly turn into an adversarial nation. It's just that the interests in Japan and the U.S. may diverge in terms of executing company policy in a way that production could be shifted slightly, or things could happen to what remains of U.S. Steel's assets should it fall into Nippon Steel's hands in a way that would hurt U.S. interests over what might be pushed by Nippon Steel and its minders back in Japan. Now, as far as the company itself, Cleveland-Cliffs has maintained its interest in acquiring U.S. Steel. However, that would raise government concerns on another front, and that is antitrust. It could pose a competition question. And would the new competition enforcers under a Trump administration look more favorably upon a Cleveland-Cliffs attempt to buy U.S. Steel? Now, the other things that could happen, we could see some of U.S. Steel's assets perhaps sold, but it really is not looking great for U.S. Steel right now at this moment, and we're seeing that in the share performance heading into the market open.
Yeah, giving up basically all of the rally that it had yesterday on its new offer. Hey, Shep, we have so much more to cover with you. We're going to have you back later in the show. We have a House speakership vote to get through. Michael Shepard, thank you so much. Okay, coming up, multi-strat hedge funds deliver in 2024. We're going to discuss the year that was for funds, everyone from D.E. Shaw to Exodus Point, with our exclusive Bloomberg reporting from Nishan Kumar. That's coming up on your brief.
It is your Bloomberg Brief. I'm Manish Krani alongside Danny Berger in New York. Front pages look a little bit like this as we close out the first trading week 2025. Washington Post leads with authorities. They are saying that the man who drove the pickup into New Orleans crowd seems to have acted alone. Hours before the attack, the killer posted videos on social media indicating he was inspired by the Islamic State. The FBI's New Orleans office is aggressively running down every lead, including those of his known associates.
Meanwhile, the New York Times has this on their front page, that South Korean officials have abandoned their attempt to detain President Yoon. There was a standoff at the president's residence that lasted several hours. Both his security team and thousands of supporters, lawyers for Yoon, repeated their assertion that the attempt to detain him was illegal.
And Bloomberg reporting that multi-strategy funds of all sizes delivered mostly double-digit gains in 2024. Some smaller funds also posted strong returns during the year that brought higher for longer interest rates in several major economies. Let's bring in Nishan Kumar, who has written up this cracking story. Nishan, great to have you with us. I mean, if you're Izzy Englander, he's happy at 15%, but he was trumped by D.E. Shaw and Citadel, haven't had to raise funds for quite a while. Talk to me about the amount of risk that these strategy funds have had to take to deliver double-digit returns, which are still below the S&P 500, but nonetheless quite salivating.
Yeah, significantly below. So if we look at history, most of these funds run at a Sharpe of 1.5 and above, with 1/3 the volatility of S&P 500. I know this comparison is always invoked on hedge fund returns, but these are two different types of returns that we are talking about.
It's two different types of returns, Nishan. And I want to get to exactly what are the sort of themes that they were able to capture. But before we get to that, even though it's two different types of returns, again, the comparison is made because you can buy a no-fee ETF and got 25% total return last year. So does this change the attractiveness of hedge funds, the fact that you are able to get double-digit returns with lower volatility? Or is it still, I don't know, the movement is to passive?
So investors are the best judge. Let's look at hedge fund from their point of view. What are they saying? Citadel, for example, made 15%, which is not the greatest return for themselves in going by their recent history. But they offered investors to take out all their profits. Few opted for that. Only they made like billions and billions of dollars in profits. Only 300 million is going out. So investors still want to keep their money with Citadel. Let's take another example, Millennium. It wanted to raise $10 billion last year. It got demand for $20 billion. They had to return $10 billion to investors that they cannot take in. If you count all the hedge funds in the industry, you'll struggle to find 100 hedge funds that manage $10 billion. Another example, D. Shaw. it's returning half of its profit, and it has remained closed for many, many years. It hasn't taken any new money. So all this shows that, there is one thing. We are in a world where there's plenty of demand for hedge funds, but not enough funds that investors really want that are open to take their capital.
Well, what's the constraint here then, Nishant, in that if Citadel haven't had to actively go and raise money, people come and knock on their door. But if I look at what wealth managers are offering, they're offering PE, infrastructure funds, they're offering, credit, small portions of credit. But hedge funds have always been there. But what is the constraint? Is it on the supply side or on the demand side?
It's both. So, if hedge funds want to raise $10 billion, it's not a straightforward game. They need to build teams that can handle that kind of return. And this market cannot absorb $10 billion instantly of capital in a market neutral strategy. So that's why that's why this war for talent is going on in the industry. There is no new supply, or there is very small supply of new talent that is coming in. So it's a very complex situation where hedge funds are seeing demands, but they cannot take in a lot of
Obviously, as you say, the supply constraint is on talent. We're going to talk about more exceptionalism in U.S. equity markets with State Street.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
No deal. President Biden decides to block Nippon Steel's takeover of U.S. Steel. New year, new drama. Congress gathers to vote on the next Speaker of the House. And FX in focus, Beijing lets the yuan weaken to a 2023 low. Parity beckons for euro-dollar.
We've reached the end of a holiday-shortened week, but unfortunately for you, 5 consecutive days of decline for the S&P 500, the longest run since April. Will today reverse that? Futures moving higher as they did yesterday morning. NASDAQ 100 leading the way after Mag 7 led the sell-off yesterday. For this bond market, some variation across regions. Jobless claims surprised to the downside yesterday in a good way. You get a rally in 10-year yields nonetheless, basically down by 1 basis point. German 10-year yield, that's also in a tight range. Everything's in a tight range, but I bring up China just to show at one point we fell below 1.6% this morning. That is the lowest on record. 30-year yields in China are already below Japan. You're in a situation where the growth looks weak in China. In Europe, you have, again, inflation being a problem with energy prices higher. And then that just brings you back around to the U.S., king dollar in equities as the trade du jour, and maybe for many days longer.
Yeah, I mean, 8% last year, 7% in the last quarter. And we just had a conversation with MUFG. Edgar Denny was on Bloomberg last night, and he was talking about these yields in China. The risk is this, 0% by the end of this year rather than the 1 point. I mean, we've dipped below for the first time, 1.6%. So the risk is that you've got a very, very aggressive and changing nature of the PBOC with a change in strategy and policy.
Yeah, but maybe monetary policy is less effective this time around because investment is so low. And that's why we keep waiting for some sort of stimulus to the consumer to get them to spend. So you keep buying U.S. stocks, perhaps, is the trade. But then how fragile is that? Yesterday, Manus, the Atlanta Fed updated their GDP Now tracker, downgrading its fourth quarter estimate for growth to 2.6%, down from 3.1% on December 24th. Equities responded with a sell-off. They erased their gains midday, ending the session lower. Joining us now, I'm pleased to say, is Cayla Seder, Macro Multi-Asset Strategist at State Street. Cayla, great to see you. I mean, what does this say to you, that equities can sell off on a data point as unimportant? I mean, I know we look to the GDP Now tracker for some sort of signal, but it's not something the Fed uses, and yet equities sold off. What do you make of that type of fragility?
Morning, Danny. Thanks so much for having me, and Happy New Year. So, yes, to get to your question, I think positioning has a lot to do with some of the reactions we see. And this was kind of a trend that we saw throughout 2024, where, this is a very data dependent market, and one data point can spook markets on the day. However, I would caution that it's not so much these intraday moves that we're really looking at. It's much more those longer trends. And so as we look at some of the longer trends, there still is some upside. However, I would caveat that that's selective upside. And so it's really those points in the data that we're seeing that guide where that upside will be.
Well, the upside last year, if you look at the returns last year, Cayla, 26% in SPOOs, 23% in S&Ps, 29% on the NASDAQ, CCC was 15%, bonds barely eked out a gain, 0.6%. How brave do I have to be this year to get a double-digit return?
I think what happens is we see a lot of the similar trends from last year because right now we're in a period where monetary policy looks to be in more of a pause. Now, one thing that's important to consider right now is the bar for a hike is definitely still higher than a bar for a cut. So a cut would be more likely in 2025. And because of that underlying expectation, we still think there's upside support for equities. However, that doesn't mean we're going to see a broadening out, because when we're in this period of kind of policy stasis, rates are still relatively high. And so what that means is that it really supports this demand for, large caps over small caps, support for, tech versus other parts of the market. And so far we see a continuation of a lot of the same trends from last year.
Cayla, this is so important because I have to say, this is a contrarian point. Manus and I have talked to so many people that are bullish on equities, but specifically bullish on a type of broadening out. Some of the thesis behind that goes to policy, goes to the fact that we're going to have tax cuts and deregulation, and that should help some of the more economically sensitive type companies and help small companies and small caps in general. Do you not buy that argument necessarily?
I think it's a relative story, because when we think about where rates are today, how can companies that are more rate sensitive be impacted by where rates are today? Well, if firms have to refinance relative to 2020, those interest rates will eventually still bite. And so from a relative perspective, it's those companies that still have stronger balance sheets and are less interest rate sensitive. So that's one reason. The second reason is, positioning. We touched on it earlier. Yes, we see overweights in areas like tech, areas like large caps. However, if we were to have this conversation January 1, 2024, you can make the same case, right? Overweights in these parts of the markets is not a new story, and what we've seen so far is that it hasn't been a headwind to equity performance overall. And so that positioning story, that can still move higher. We're not at the caps just yet.
Cayla, obviously you want to stay at the top of the stack, at the top of the pyramid. That's very, very clear. That's setting out your agenda. But if I look at the MAG 7, the earnings per share growth last year was 33.5%. That's expected to slow to just under 18%. That is still a mighty performance relative to the rest of the market. But the rest of the market earnings are expected to broaden, and the AI theme is expected to broaden. How do you capitalize on that?
There are a couple places where that could be an option. One place we saw last year that really stood out on some opportunity for AI was the utilities, where if you had investors that wanted to be a bit more defensive, they could get that defensive upside and opportunity for AI within that utility space. And so that's one place we saw specifically institutional investors get more excited about than they had in the past. And so, keep in mind, those are more longer term investment horizon investors. And so I think that's one maybe underappreciated sector that caught our eye last year.
Cayla, thank you very much. Let's see how 2025 shapes up. Reach out to the hedge funds, reach out to the tracker funds. Take your poison. Cayla Seder there off State Street. Other stories trending on your Bloomberg terminal this Friday morning. This is what we've got for you. The U.S. banking system's reserves tumbled below $3 trillion to the lowest since October 2020. The decline comes as year-end dynamics force banks to pare balance sheet intensive activities in order to shore up the books. Strategists have been paying close attention to the lowest comfortable level of reserves, which some have estimated to be between $3 and $3.25 trillion, including a buffer.
Meanwhile, China is planning to increase its scrutiny on tech exports that help make battery materials. The goal there, protect dominance in global battery and EV production. There's also been rising competition with the U.S. in everything from critical minerals to semiconductors and tit-for-tat trade restrictions. These curbs target a selection of processes used to make lithium chemicals that are in turn crucial for battery performance.
7-4 reports that Meta is replacing his global affairs president Nick Clegg with Joel Kaplan. Now, his deputy and the company's most prominent Republican. Kaplan has been one of the most forceful voices inside Meta against restrictions on political speech, saying such policies would disproportionately mute conservative voices. Coming up in the show, it is no deal for steel. President Biden set to block Nippon Steel's takeover of U.S. Steel. More on the story on Bloomberg Brief. Bloomberg Brief. I'm Menace Cranny alongside Danny Berger here in New York. So U.S. Steel is plunging pre-market. President Biden set to block the sale to Nippon Steel, seemingly killing a $14 billion deal before President-elect Donald Trump takes to office. Mike Shepard is tracking the story from Washington. Mike, it was a Hail Mary last offer from Nippon Steel yesterday. It looks as if those prayers are going to go unanswered. A $500 million penalty fee. But it looks as if this is going to end up potentially back in court or a lawsuit. I mean, what's the possible outcome of a lawsuit? Is it worth it for Nippon Steel? Is there any way back from this blockage by this Biden White House?
This is a real tough decision to try to reverse in court, because courts, as we have seen even in the most recent TikTok ruling in Washington just a few weeks ago, have really given deference to the government, to the administration, be it Republican or Democrat, when it comes to matters of national security. And this is an argument that the Biden team will invoke, even as there are also other political considerations at play. There are economic ones, too, and those are going to be seen unfolding as we deal with the consequences of this decision for U.S. Steel and for its workers. Nippon Steel and U.S. Steel have both said that the deal was necessary to be able to preserve jobs, to be able to preserve U.S. steel production here in the U.S. and build it up and get the investment that is needed. But without that, we could see actually some job losses and some big shifts and perhaps some asset sales, too.
Shep, elsewhere in D.C., we have a House speakership vote that kicks off today. Mike Johnson faces a nice edge vote with some far-right holdouts. But we've seen in past times Kevin McCarthy changed rules in order to appease them that eventually, more or less, led to his ouster. What sort of balance is Johnson likely to hit today to get that re-election done?
Well, this is a really tough path for him to walk today. He has President-elect Donald Trump's endorsement for another term as House Speaker, but the majority for Republicans in the chamber is the narrowest any party has held in the House in decades. And this makes it really hard for him to lose any votes. And we've already seen Representative Tom Massey say that under no circumstances would he be supporting Johnson for another term as Speaker. That means he has literally no other votes that he can afford to lose at this point. And that puts him in a position of having to negotiate. But whatever he gives up to conservatives like Tom Massey, he puts at risk whatever support he might get from moderates, too. Moderates have signaled they don't want Johnson to make too many concessions when it comes to spending and other policy areas that they find troubling or concerning. So this will be a real balance for Johnson to strike. And the risk is that the process of choosing a speaker drags out. Now, you brought up Kevin McCarthy. 2 years ago at this time, it took McCarthy 15 rounds of voting to eventually win the gavel. And then when he was ousted 9 months later, in essentially was a coup led by conservative members of the Republican caucus, it took nearly 3 weeks to settle on Mike Johnson as a speaker. So we really do run the risk of a battle really unfolding unless Johnson can get everyone in line when the House convenes at noon today.
Well, it's not going to be a simple thing, even though he has Trump's backing at the moment, complete and total endorsement, a good, hard-working, religious man. Briefly, let's square off because we're understanding more about the shape and the complexion of Scott Bessent's team over at Treasury, and it's a veteran of tax policy that looks to be joining the team, Ken Keyes. Quickly, a mention on him, Mike.
Yeah, he is worth watching over the next year because he will be the point person in getting through this narrowly divided Congress a tax package that matches what Donald Trump had promised on the campaign trail. That is a big cut in corporate tax rates from the current 21% to 51%. 15%, and also some of the other big breaks, including exemptions for tipped income and retirement income that the president-elect has promised to deliver to voters. And it will require someone with that kind of savvy, somebody like Ken Keyes, who has represented Microsoft and other big business interests like insurers and financial services companies. As a lobbyist here in Washington, he will know how the levers of power work, how to curry favor with lawmakers to get the votes they need to get what will be a tricky and complex tax package through Congress by the end of the year. It will be tough to meet Trump's goal of trying to get it done in the first 100 days, but he will have to hit the ground running even to get something done by year's end.
Gotta say, a good buyer beware label for all those participating in a post-Trump risk rally on tax cuts. Shep, thank you so much for joining us 2 times this morning. We really appreciate it. Michael Shepard there. Let's stay on politics. Before his successor takes over, President Biden is preparing to issue a decree to permanently ban new offshore oil and gas drilling. Let's bring in Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, how permanent would a ban like this actually be? Will it complicate Trump's desire to ramp up domestic energy production?
Yes and no. I think the law under which Biden would put some offshore grounds out of bounds means that it is quite hard for Trump to overturn it. But it's worth stressing that it is not in areas where drilling is currently happening in places like the Gulf of Mexico. It's places where they would happen a long time in the future, near Florida or even on the Pacific coast. So its impact on oil production next few years is going to be marginal at best. There is lots of activity predicted in the Gulf of Mexico in the offshore sector. BP, for example, has a plan to develop lots of new projects in the deep water off the Gulf of Mexico, and that wouldn't change. So in the near to medium term, I think that its impact would be marginal. And to be honest, a lot of this could be seen as performative, a signal from Biden to his core supporters that he is going to pursue this agenda until the end. We should also remember the context, Danny, that under the Biden administration, oil and gas production has never been higher. It reached a record. So it's not as if this is actually part of a campaign against a successful campaign against oil and gas production in the US.
Well, good morning to you. Yeah, I mean, Trump himself used the same legislation in 2020 to block off some Florida and southeast coastal areas. Talk about what energy dominance. I'm fascinated to know. Scott Bessent has promised 333, the plan of threes, and the third leg of that stool is 3 million oil and gas equivalents to grow the energy production of the United States. A, do they have that capacity? And B, what's that going to actually look like for OPEC Plus? This drill, baby, drill, because they can't even put their own supply back onto the market at the moment.
I think most people would think that that target is very ambitious, but clearly Trump wants lower oil prices. He wants to have strong production of both oil and gas in the US, and I think the expectation is that it will continue to grow, as it has done under Republican and Democratic administrations for the last 15 years. That will continue. Whether the pace will be quite as steep as it has been or whether it will taper off a bit, I think is a matter of debate. The Permian Basin, the main shale oil field in Texas and New Mexico, which has really driven gains in oil production in the US, is maturing, and I think a lot of people in the industry think that it can't grow as fast as it can. But Trump will mean at the margin less regulation, more leases, more encouragement, and definitely a vibe which is pro-oil and gas that the industry is likely to respond to, so we will see higher production. It will put OPEC in a tough spot in 2025. You're seeing that US production, you're seeing more production from places in Latin America as well. And against the background of what was relatively weak demand towards the second half of this year and uncertainty about the Chinese economy, normally a driver of demand, I think that OPEC could have a tough year, but it will all depend on the outlook for the global economy ultimately.
Absolutely. Will, thank you very much. Will Kennedy there with the very latest on the energy policy here in the United States of America. Let's turn our attention back to the FX markets. Things are moving quite briskly this morning. Onshore Chinese yuan on your screen at the moment, hovering around 7.3, breaking through there. Beijing letting the currency weaken beyond that level that it's been defending, one could say, since December of last year amidst a sluggish economy. Noor Al-Ali joins us, Bloomberg M Live team. Noor, good to have you with me. Just looking at this break, I'm surprised that they're letting the yuan, as it were, metaphorically, off the leash ahead of the Trump tariffs and knowing what they are. Does this signify a shift in gears on a weaker yuan tolerance at the PBOC?
Good morning, Manus and Danny. Look, it's very interesting, right? Is this a positioning ahead of tariffs? Is this a way to kind of prevent against what we may expect coming from Trump just weeks ahead of his inauguration? That is yet to be seen, though. What we know so far is the Chinese economy has not been doing very well. We have seen it stabilize in December, some elements of the property sector stabilizing there, but still, after all that stimulus effort that we've seen from China, still the economy and domestic demand is quite low. Now, the Chinese government is expected to reaffirm its GDP target of 5%, the same as last year, though that is still debatable whether or not they can stoke that domestic demand. There's been an abundance of data and a lot of points pointing to the idea that just that deflationary spiral in China continues to take a hold over the economy. And what that means is lower yields and the yuan potentially even falling further to bounds that the PBOC would not like. Now, whether they'd allow that free fall, I don't know if that's likely. Strategists expect more of a gradual fall for the currency. Of course, you've also had that dollar dominance weigh in as well. So there's a lot at play here for both the Chinese economy and domestic demand here.
Noor, it's been much too long. Thank you so much for that roundup. We really appreciate it. Bloomberg M Live's Noor Al-Ali. Coming up, it's a busy day in Washington, D.C. Fed speak, a vote on Capitol Hill. We'll break it down for you next. Welcome back to Bloomberg Brief. Danny Berger, Manish Cranny, setting your agenda in New York. And let's set up your day ahead, your trading day on this Friday. We're going to get ISM manufacturing at 10 a.m. Eastern. That will be followed by remarks from Richmond Fed President Thomas Barkin at 11 a.m. And then a razor-thin margin for a vote for House Speaker. That takes place with Mike Johnson. He just got the endorsement of President-elect Trump. If he doesn't pass this, more rounds will come. Manus.
A couple of stocks, Danny. Just keep an eye on USD. We've done that several times. Obviously, the no deal for steel with Nippon Steel. Tesla picking up after closing down 6% yesterday. And Constellation Energy continues to rally, fueled by $1 billion power deal with the U.S. government. What's our stat of the day on stocks?
This overall equity market, it is a rebound for the future session, but we are now down 5 consecutive days, Manus. The stat you have been craving is that is the longest losing streak since April. So not a great start to the year.
No. State Street, however, stays top of the stack. They want to be long big growth. That's it. Surveillance will take you through the next couple of hours.